Hello and welcome. You're watching all about your company here on ET Now, and today we're going to be talking about a company in the packaging space, Moldtek Packaging. Why is it in focus? Well, it attracted my attention for two reasons. One is that you've got 9 analysts tracking this counter, and they have a 57% upside is what they are suggesting on this counter. So one of the largest upsides that we're seeing within the smaller cap basket, and on a sub 2,000 crore company, to have 9 analysts tracking it and having this upside, really that stood out for me. The second piece was the fact that there could be recovery starting Q4. Now, I'm trying to get a trend as to whether volume growth outlook could actually surprise in Q3 itself, given the GST rate cuts. And I was also curious with management commentary suggesting that that will only happen in Q4. Why not Q3? Really, couple of those factors. Also, it's into the packaging space, so it has a very good correlation with paints, with quick commerce, with food delivery and the like. And therefore, you might well see this one looking at an interesting point. Valuations trading at around 20% lower than its 5-year averages, and that's the other piece. Now, what I want to know, one, volume growth. We spoke about that for a bit. Realizations and EBITDA per kg. This has shrunk and shrunk sharply. In terms of your realizations, they've come off by around 10 to 15%. Maybe 10% odd is what it's come off by on a QOQ basis itself. And EBITDA per kg is also down by around 5% or thereabouts. From 41 rupees, which is your EBITDA per kg, it's down to now 39 rupees. Whether a bounce back there can be anticipated. Q3, why is that expected to be soft? You know, you've got GST cuts which have gone through the system now. Q3 ought to be stronger. I'm trying to get a sense as to why that is so. Also, 12% on the volume growth front. Is that something that one can continue to pencil in despite a soft Q3 if that were to play out? The fourth piece is Asian Paints and the overall paint sector. Now, this one has a fabulous visibility of what's happening in the paint space. It supplies, of course, to Asian Paints, but 44% of its top line actually comes from the paint segment in particular as a whole. So it has a very good correlation or very good understanding of what's happening in the paint space as well. What's the impact of raw material on margins? That's the other piece which I'd want to know, because they've been very steady, that margin number, and we'll come up with it. What's causing that steadiness? And debt and capex outlook. We've seen debt creep up very, very silently. What's the outlook like with regard to debt as well as capex? We'll try and get an understanding of all of this hopefully by the end of this conversation. Let's start off with what the company does. It was incorporated in 1986. It's a rigid plastic packaging manufacturer, and it's a pioneer in mold labeling technology. This is as part of the mold itself to be able to label. A lot of times you make the packaging and thereafter you label. This the company specializes in mold labeling, so or rather it's a first in mold labeling, and therefore it stands out. So what does it do? It makes plastic containers and buckets, serves paints, lubes, food and pharma sectors. Those are the broad sectors that it services. In terms of paints, it services paints through pails and containers for decorative as well as industrial paints. And that is obviously the largest contributor to revenue as well. We spoke about that. In lubes, it packages for lubricants as well as oils. In food and FMCG, thin wall containers, cups, tubs, beverage bottles, sipper cups. It covers across the value chain. It covers food and FMCG packaging. And then there's bulk packaging, large format, rigid packaging for paints as well as industrial consumers and customers, all B2B. And then there's pharma and nutraceutical packs as well, where you have EV tubes, stoppers, and the like, all of which it takes care of in terms of the packaging industry. It's just 1,800 crore in terms of market cap, despite having a 10-year listing history, over 10-year listing history, if I can call it, if I don't go back even further. Let me talk about the segment mix, and that's on your screen. 44% paints, we spoke about that. Lubes is around 16 odd percent. Food is around 19%. Food FMCG. Bulk packs is around 16%. Pharma is 5%, and that's broadly the way in which the top line mix shapes up for a Moltec. Let's talk about clients and some marquee names that you will see out here. Asian Paints, Amul, Wipro, Dabur, Castrol, Shell, Mondelez and HUL, all of which are clients of the company. Now let me quickly shift over to the metrics and talk about the income statement. If you look at the income statement, well, it's an unenthusing set. It will not interest you much. You look at the way in which FY22 to FY25 numbers have shaped up, we're not seeing a very large uptick at all. In fact, just about 7% compounded growth is what we've seen. You'll see that at the top of your screen. The 3-year CAGR is just 7% on the top line. Let's talk about EBITDA. And that has in fact grown at just about 5%. So no margin tailwind either that we can see. And profitability, in fact, is absolutely flat over the last 3 years. We've not seen any uptick with regard to profitability. So that's a concern. Let's talk now about the H1 numbers, because that seems to be a little more interesting. You look at the growth, YOY, 16% on the revenue, 23% on EBITDA, and profitability up 19% YOY on H1 numbers, FY26 versus FY25. Let's talk about the margin trajectory as well. The margin trajectory has been extremely flat between the 18 to the 19.5% number. And therefore, what we're seeing is that it's able to maintain very steady margins. So despite the growth not coming in, the margin trajectory is fairly decent. What the commentary also seems to suggest is they're able to now start to build in lesser plastic into their containers, because you have a better quality of container which is getting manufactured, which means that volumes may not necessarily go up, but the value might continue to go up, because volumes depend on the plastic which is used, whereas value depends on the number of plastic containers manufactured, and therefore that is the better metric to look at. So we will talk to management with regard to top line growth and how this trend is playing out with regard to the numbers as well. Now let me talk about the balance sheet, and it's an okay balance sheet. You're looking at the total book value being at around 670 odd crore, but look at the borrowing number. It's doubled or it's nearing doubled versus FY24 start in H1 of FY26. They're doing capex, they're ramping up on that capex, and really the important piece here is how ROCEs are shaping up, and you will see that ROCEs have fallen as a result of the kind of capex they've done. So we will talk about that, but let's talk about cash flow first. We'll talk about return ratios in just a bit. In terms of cash flow, you'll see cash flow from operations hasn't gone up in a healthy fashion. EBITDA also has been fairly stagnant, and we're not seeing a very strong cash flow to EBITDA conversion either. We'll talk to management about some of these trends which are playing out. Net cash flows may be less important because of the quantum of capex that they've been doing. They're expected to do 100 crore capex in FY26 as well. That's large for a company of this size, and therefore some perspective. You look at the ROCEs now. In terms of the return ratios, it's been very healthy, frankly, all the way up to FY23. FY24 is where we're seeing dips, and FY25 has been difficult. I want to understand whether they can change this at all as scale starts to build up. The current capacity utilization also has fallen in H1. I want to try and understand whether H2 will be better from a capacity utilization perspective, because that will likely aid the return ratios as well. Let's talk about the shareholding, and 33% promoter held, not the best. When neutral on this. FIs have a decent holding, so do DIIs, and no real material change. FIs have pulled out some money, but not material, and DIs have held on to their stake. The public the public stake has inched up a little bit in this. So that's the broader trend that's playing out. Let's talk about valuations. Trades at 25 times FY26, 19 times FY27. Mind you, the range, the 5-year range of the price to earnings on a Moltec is anything between 17 times to around 34, 35 times. So this is currently trading at the lower end of the range. In fact, when I'm looking at the 1-year forward, the price to earnings multiple is 20 times, which is definitely at the lower end of the range. That's where we get comfort, but there's no growth. Really, that's the key. There's no ROCE pickup. That's the key. So those are the two pieces which you want to wait and watch out for. There are 9 buys, 2 holds, no sells. And the upside that is being seen is a massive 57%. We spoke about that, and that's what really stood out for me as well. Now, in terms of the snapshot, let's give viewers a quick snapshot with regard to how this has shaped up in terms of our analysis. And let's bring on board the management as well of the company. There you go. That's a snapshot. No thumbs down. That's the positive. The P&L account, though, I am a little, not the best in terms of the way growth has shaped up. So I'm a little cautious. But overall, it's an okay looking graphic in terms of the overall graphic that we showed you. Now let's bring on board Mr. Janumahanti Lakshmana Rao, who's the Chairman and Managing Director of Moldtek Packaging, joining us this morning. Mr. Rao, let me first start off by understanding what trends are playing out. Growth hasn't been the best for you over the last 3 years. Are you expecting a meaningful or a significant pickup in growth H2 or FY27 at all? Give us that indication first to start off.
Good morning. I've been watching your analysis, couple of errors I noticed, but anyway, apart from that, the growth is picking up this year. You have seen the first half, we have 10% overall volume growth, and in terms of revenues, it is a 16% uptick from 780 crores. Probably we may end up this year close to 900 crores, which will be almost like 12 to 14% revenue growth. This is something which was not there in the last couple of years or 3 years, because basically last 3 years where we are building up capacities. We have built up 3 plants at Panipat, Cheyyar, and at Sultanpur here in Hyderabad. And the 4th one at Mahad is also is being supported from Satara, but it is also under construction. So all these plants investments were being made in greenfield projects. That is what is impacting ROC as if because the capital has increased much higher than the sales growth. But it will be catching up in these couple of years. Already we are seeing a 10 plus growth for this annual year ending 26 March. And from there onwards, I'm positive that our growth will be in double digits, because not only the 3 plants are now up and running, even the extra facilities that have been created both at Panipat, Cheyyar, and even at Satara are now being utilized by ABG in a reasonable manner. The capacity utilization is slowly creeping up. It was only 62-63% last year. It's now coming close to 69%. And I think the whole year we will cross 70. And next year we can look forward to our best capacity utilization, which is around 75 to 80%. Beyond that, it is not possible in a packaging industry, which is subjected to seasonality, especially monsoons and winter season. The demand for some of our products dip a lot, causing some seasonal variation in our performance.
So going forward, point, Mr. Rao. Fair point. Fair point. Apologies for interrupting. Talk to us also about what is it that you disagree with? What is it that you would want to change with regard to whatever I have said about the company? Please tell us.
No, the cash flow statement when you are showing, yes. If you go back to the slide, I think there is a mistake in that calculation.
Okay. All right.
Here the cash what do you mean by cash flows of 25 is 110 is correct. The year before that?
Okay. Sir, we'll get to that. We'll get to that in just a minute. Understood. Okay. Sure. Okay. So, sir, there's going to be a ramp up with regard to capacity. I understand that. Talk to us about what this does to top line. Right? You've seen very, very mild growth over the last 3 years. What next with regard to top line growth? Where does it go in FY27 as you hike your capacity utilization beyond 75% is what you are aspiring for?
Yeah, we will be definitely crossing the 1,000 crore mark, because we'll be hitting close to 900 this year. That is up by around 12 to 13%, or maybe 14%. And going forward, it may even ramp up from next year, because pharma and also the Panipat plant is started manufacturing both capex and thin wall products, that is food and FMCG products. That capacity utilization also will start picking up from February onwards. 2 sets of machines were set up, and now that will become 6 sets by March, and that will start adding to the numbers. So these molds are what are, sorry, I have to just mute it. Yeah. So
Yeah.
the numbers in pharma are also shooting up. As I said last year, we are about to meet the projected turnover of 35 crores for the current year, up from 9.5 crores or 10 crores we did last year. But of course, that kind of 3 times growth is not possible. But we are looking at least a 50% growth in pharma packaging, which will touch around 34-35 crores this year. And we will be aiming at 50 to 55 crores for the next financial year. So capacities are already built for that. Even the minor adjustment in storage space is also ready. So that is another big addition that will come up in the company's operations.
Understood. So you hit 1,000 crore in terms of top line likely by FY27. I'm trying to understand what next. So if I look at the 3-year picture, you will be at 75% capacity utilization. You've described the fact that it's a seasonal business and therefore capacity utilization creeping above 75 will be difficult anyway. So therefore, what's in store for the next 3 years? How do you see the growth part there? Is there additional capex required?
There will be brownfield expansions required continuously because some of the old machines need to be replaced and some of the balancing equipment in pharma have to be added. Looking at the traction, what we are getting from big pharma companies in the last 1.5 years, it's very heartening. And those capacities need to be added. One good thing is land and buildings won't be much added in the next 3 years for sure. Only the small construction activity at Mahad, which is already underway, will be completed by hopefully March, April. And thereafter, there'll be little addition to the land and building, which are non-performing assets. But there may be some additions of machinery, certainly in pharma, where we need to add capacities as we are trying to reach 100 crores turnover within next 3 years. So there will be certainly some more investment of say 20 to 30 crores every year, and replacement of machinery to the tune of around another 20 to 30 crores. So probably our capex budget, which has been running above 120 crores for last 4 years per annum, will come down to 60 to 70 crores in the coming 3 years. But that will still create a growth momentum anywhere between 12 to 14% in the next 3 years is our projection.
Understood. So currently you're penciling in maybe from the current base hitting 1,000 crore by FY27 and thereafter maybe 12 to 14% growth. So that's the kind of glide path. Talk to us about FY26 in particular. What has happened in H1 and why is it that you haven't guided for a pickup in demand in Q3? Why are you expecting that to come in Q4? What's the rationale there?
See, basically, there are two things drive our seasonality. One is Diwali, that is festival season, and the second is the monsoon. This year, extended monsoon, which started right in the beginning of May and went on till end of October or middle of October, has impacted the demand for paints, demand for other products like ice creams and curds, yogurts, and all frozen products. So those constitute sizable amount of our product sale. Paint constitute almost 40-45%, which has also dipped in the monsoon time. And ice cream and yogurts constitute almost 10 to 15% of our sale. So their consumption has come down right from May itself. In spite of that, I'm very happy to see that we have made a 10% growth in the H1. And in the H2, the Q3 started slowly. Soon after the festival, there was a lot of the early Diwali also makes the festival time little difficult period for consumer goods, consumption. But fourth quarter looks better because the pent-up demand for the paints I see is improving in November, December onwards. And going forward, that pent-up demand will definitely come in because of the CST cut, not only in paint, but also consumer goods. And there are a couple of good wins we have in FMCG products for which the molds are getting ready. They will be going into production from Feb onwards.
Sure, understood. Talk to us about raw material prices and the impact of that on your EBITDA margins. You've been very steady where EBITDA margins is concerned. I have to give you that credit. What helps you maintain this kind of margin despite raw material prices being slightly choppy, if I can call it that?
In fact, raw material prices have been softening over the last 1 year, 6 months
Yes.
at least. We don't get much benefit out of it because we pass on the pricing on a monthly or quarterly basis to the client. So either the raw material goes up or down, it has very little impact on our EBITDA. What improved the EBITDA is we have started integrating the facilities. Now in Hyderabad, we used to have 5 plants. Today it's come down to 3. And we are in the process of merging one more small plant into Sultanpur, thereby operations, integration, and cost reduction, better, a movement of goods would come down and cost will improve and will decrease. So that is what is we are seeing in Hyderabad plants. But better utilization coming forward in the next couple of years is going to definitely improve the EBITDA, mainly due to pharma, which is a high contributor to the tune of 100 plus rupees per kg compared to our average of 40. If it start building up to 10 to 15% of our turnover in the next 3 years, that can really be a good value add to our bottom line.
Can you do 15% in 3 years from pharma?
10 to 15% is definitely possible. We are aiming at 100 to 120 in 3 years.
And where would that take your margins, sir, if I may ask?
See, if we achieve that number at, let's say in 3 years, we reach it now about 100 to 120 crores, it will certainly pull up the EBITDA margin by 3 to 4 rupees overall EBITDA margin. And if you also notice last year, we were only at 37.6 and this half year we are at 40.6 EBITDA. So that is the kind of EBITDA improvement we can still look forward to once the pharma reaches a sizable contributor, and also better utilization comes into all these greenfield projects where we invested in the last 4 years. I'm sure Panipat utilization will go beyond 70 next year, 70, 75. Even Cheyyar is going to reach because we have moved a part of Gulf demand to Cheyyar, Gulf lubricants. So the capacity utilization is going to improve. And bringing those companies under one roof in Sultanpur is bringing a lot of cost reduction and better output.
So if I'm doing the math right, you'll be at around 1,000 plus crore in terms of revenue. You'll do around 200 crore of EBITDA and you're guiding for capex of only 60 to 70 crore annually. Do you therefore utilize the balance cash to repay your current debt? Is that the way one looks at it?
Yeah, it can be used to reduce the debt, which is not very high, considering the debt equity of 0.33, which is very, very modest. That too inclusive of working capital. Our debt equity ratio is just 0.33, which is very low compared to the industry average. But in spite of that, those funds, whichever overflowed, would be used for either expansions in other areas we may get into. For example, recently we have signed a MOU with Vibe UK, who are pioneers of pioneering company in closure, industrial closures has started this. And the team is going to give us their patent rights and designs for some of the industrial closures, which they will sell in Europe and USA. So that is another new segment we are starting now. I am not going to say that in the next few quarters itself, it is going to add big values. But by 27, 28, we will see considerable numbers. Already 3 product designs have been shared with us last week, and we have to come out with the feasibility report and making the trial molds. And probably in 4 to 5 months' time, these products will be marketed by them in Europe and USA for the clients with whom they have been associated for more than 30 years in this field. So these are the new segments we are trying to get in. It will be useful to use the idle capacity to some extent. But once these numbers reach something like 30, 40 crores per annum, then we need to add few more machines, but not much space because they are small caps and closures of high value.
Sure.
Won't be required huge space.
Sure. Mr. Rao, it's been a pleasure speaking. It's been great understanding the forward-looking expectations that one can have from Moldtek Packaging. Thank you so much for joining us this afternoon. I'm sure that gave viewers a lot of food for thought. And viewers, completely out of time on this edition of AAYC. Stay with us here on ET Now. More action to follow.